Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Today I'm going to take a look at the Coca-Cola company, ticker KO, and the reason for that is because they're down 12.5% year to date, down almost 20% since their all-time highs, and it seemed like an interesting time to look at it given the recent downturn. Everybody knows what Coca-Cola company does, so I'm not going to talk about what they do. They make soda, coffee, water, etc. They're now moving into alcoholic drinks as well, Jack and Coke type stuff in a can. So interesting business area for them to be in. But their revenue growth is slowing, and I think they've been kind of buoyed by low interest rates for a while, and now the market is moving against that. So just taking a quick look at their overall performance here, 7% revenue growth in the last 5 years on average, 10% operating income growth, from 5.3 billion free cash flow to 9.5 billion in 2022. So pretty solid growth, and really they refresh the world. They make a difference. Maybe they give some people diabetes, but what are you going to do about that? Can't get by without sugar is what I always say. And really, the Coca-Cola company is a dividend aristocrat, probably why they're such a popular stock, but they haven't been a huge performer for investors. If you look at 1 year out, down 3% prior to dividends, 3 years out, 3.4% annual return prior to dividends, 3.9 5 years out prior to dividends, 3.3 prior to dividends. So if you include dividends, you're talking about maybe 7% return on an annual basis in the last 10 years. Given how the market's performed, not too amazing. Now, the reason people invest in this is consistency, and there's certainly consistency in their financials. You can kind of see free cash flow almost always growing, really solid margins. Now, there was a bit of a downturn in revenue in 16, 17, and 18, but a lot of that was because they were franchising some of their bottling operations, so it's not comparable to today. So it's a bit of noise there. But if you look at example 2009, still very positive net income, still able to pay and grow their dividends, still generating cash from operations, still generating free cash flow through 2020, even though their revenue shrunk a bit, still generating free cash flow, still paying their dividend, still growing their dividend. That's why people like this company. Now, the problem is that this company in recent years has existed in a really good zone for dividend payers. When treasury rates were close to zero, and they have been since basically 2009 after the Great Recession, they've been dropping since then. Dividend stocks did really well, whether it's companies like Coca-Cola or utilities or whatever. Dividend aristocrats thrived because if you couldn't find a yield on a bond, you went to the next best thing, a consistent dividend payer like Coca-Cola. And that's why when you look at their PE multiples, these stocks really expanded in the last decade. They went from, 15, 16x multiples prior to the Great Recession when the treasury rate was as high as it is today, all the way up to almost 30 in the last decade or so. And now this little reduction in price still takes it down to only a 20.2 multiple. So if you kind of think about, well, the last time the treasury rate was as high as it is today, these things were trading at a 16x multiple. Now, even after this, 12% reduction the last year, it's still 20% above that. So is there further decline to come? And to compound that, they're not growing as fast as they were growing in the last decade. When you exclude the bottling operations, they're kind of slowing down. 2023 estimates have them growing at about 4.5%. A lot of that growth is coming from price increases, not really from volume growth, or they're not really taking market share, maybe a little bit, but there's a lot of competition in the soft drink space. They've made some acquisition to juice this growth in the form of Body Armor, in the form of Costa Coffee, in the form of Topo Chico. Took on a bit of debt, issued some shares to do that, but really Body Armor is kind of struggling to be integrated within the business, not doing as well on the growth side. The business is still doing well. The margins are still really good. The free cash flow margins are still really good. They're growing their dividend, but the question is does it deserve a multiple as high as it's getting today in the face of expanding treasury rates, right? If you think about this stock and its financials, at the end of the day, they're attractive because they're consistent, but they're also attractive because they pay a growing dividend. And at today's price, the dividend is about 3.5%. Now, that was pretty attractive a year or two ago when the bonds were paying 0%. But now you can go to the bank and put your money in cash and get a 5% return. You can buy a 2-year bond and get a 5 to 5.5% return. You can buy a 10-year bond and get almost a 10%, a 5% return, sorry. Is 3.5% as attractive as it used to be? The answer is clearly no, and that's why the stock is contracting despite really no news, right? It's the same thing that's happening to other companies in the utility space or other companies that are generally seen as safe dividend havens. They're going to start contracting because they have to get used to that new risk-free rate as investors now have alternatives and no longer have to put their money at risk if they're simply looking for a safe 4 to 5% yield, right? That's not what's happening here anymore. This is not a safe 4 to 5% yield. There's a bit of risk here, right? There's a bit of risk as you see with the price reduction, and that risk is coming to light because there's now a fixed income alternative. This is a similar story to what we talked about in the REIT video I made a couple of days ago. There's now alternatives. Maybe if a company has a ton of debt, it doesn't really apply to Coca-Cola, their debt is pretty manageable. They will have to refinance at higher rates. That'll flow down to the bottom line, make their business a bit less profitable. How is that going to impact our dividend? Yada, 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 all of that stuff. So with all that in mind, let's look at the valuation. So again, this is a company that pays a solid dividend. They're shelling out, $7 to $8 billion a year in dividends. That's a solid amount, but it's still well covered by their cash flow. However, if you think about, well, what are they going to pay in 2023 versus what are they going to bring in on the free cash flow side, it's probably about 85% of their free cash flow. It goes out in the form of a dividend. So it doesn't leave a lot of leeway to buy back shares. And as you can see, in the last 4 years, they actually issued 1.5 billion in shares in the form of stock-based compensation or share issuances versus actual buybacks. That's simply because they don't have a lot of leeway because so much of their money goes out to pay that dividend. On top of that, they don't have a ton of money to pay back their debt. So they're going to have to either improve their margins to pay back debt and or take on more debt at a higher rate to pay down the principal when it comes due. Luckily, they don't have a huge amount of debt and it's Coca-Cola. So they have a very nice debt rating and can take out debt at a reasonable rate. I think their current rate is something like 3.5%. So even if they increase that a bit, it's not a huge deal. It's probably going to go up at least 200 basis points if they have to refinance, but it's still a pretty decent yield rate for a large company like Coca-Cola. So not a huge risk for me. The main issue for me, though, is that one, their growth is really slowing down. They're only expecting 5 to 6% growth in 2023. They already said they're going to get about 9.5 billion in free cash flow in their latest earnings announcement. So I'm kind of taking them on their word on that. Going forward, I'm sort of assuming, hey, we're going to see about 5% growth on an annual basis, kind of similar with what the analysts are estimating. And then I'm being slightly more conservative on the free cash flow margin side. They're getting as high as 24% on some of these years. I am showing improving margins in the next couple of years, about 21% for 2023, and then slight improvements into 25, and then slight improvements into 27 as well. A slight buyback, only about 10% of their free cash flow towards buyback, and that might be aggressive given what we've seen in the last couple of years, but I'm hoping they use some of this money to buy back shares. Now, it's not too bad that they haven't been buying back shares because they probably saw what the market is seeing now. Maybe they were a bit overvalued in relation to the potential of rising rates. When you're talking about a 27x multiple for something that's growing at maybe, mid-single digits, kind of expensive. And the reason for that is they're a dividend payer. They're a S&P 500 aristocrat. They get a bonus because of that. The market just values them slightly differently because of that. However, the question is, how differently should they be valued? For me, right now, they're getting about a 4.2% free cash flow yield, maybe a 5% earnings yield. That seems a bit low. I think something like this should be valued closer to the risk-free rate. Maybe a bit lower is fine because they are going to grow a bit, whereas the risk-free rate has nothing. But you do need some sort of premium here in order to account for the fact that you are a stock. And stocks have risk associated with them. Now, the market obviously assigns less risk to something like Coca-Cola with their history, with their dividend payout structure, with their free cash flow consistency, but there should be some sort of risk factor assigned here. So I'm saying that it should be closer to the 5% free cash flow yield, and maybe even that is a bit conservative, a bit aggressive rather. So I'm putting 75% of the weighting on the 5% free cash flow yield scenario, 25% on the 4%. To me, at today's price, based on these scenarios, and you can play around with this, I'll share the spreadsheet in the description down below. You're expecting a 7.3% expected return, including dividends. And that kind of makes sense to me if you think about their 10-year history. That's kind of what they've done. If you're okay with a 7% return, starting from today because you like the safety of Coca-Cola, because you think maybe there's some upside to what I'm showing here, that's probably what you get at a $52 price point. To me, that seems mediocre, and that is inclusive of dividends. What I have laid out here is I generally target, 10 to 15% pre-dividends on some of these investments that I make, especially in a market like today when cash is yielding quite a bit of money. And you can just wait for deals to come up. So when I'm talking about a 10% pre-dividend return, that's more like 13.5%, which might be a bit high for something like Coca-Cola, given their history, given their tendency to be a solid valuation on the stock market. Maybe the market won't take it down this low. But if it were to go down to a 10% return with a 3.5% yield, I'd definitely be happy with that. And that would be a fair value of about 39.37. So 25% off of today's price, which again, may seem very aggressive, but if you kind of think about the P ratio at 20x versus the 16x that kind of had when the treasury rate was this high last time, that's also a 20% reduction. Is it crazy? Is it out of the norm? Maybe, because the market generally doesn't get that conservative on these S&P 500 aristocrats. But again, if a recession happens, if there's a bit of a cut to their earnings, certainly there's some risk, even with a stock like this. I don't think there's any risk of them cutting their dividend. I don't think there's much risk of them suddenly being negative profit or anything like that. After all, this is a company that's got a great history. But again, $39 would be a really great price point for me. If you're more comfortable with something like a 10% overall return, which would be 6.5 prior to dividends, and maybe 10 after dividends, you're talking about a fair value of about $46. So still about 11% below where it is today. And I know people are out there maybe watching this video and saying, you're crazy. Coca-Cola is never going to go this low. But why not, right? Why can't it go lower than it is today? After all, it's been buoyed in valuation by something that no longer exists, right? If you're talking about a year where rates on the risk-free side are approaching 5%, maybe there's talk of them going higher. There's talk of them staying long for an extended period of time. And you can't compare that to pricing that you saw 3 years ago where that risk-free rate was close to zero, right? It's a completely different world. The last time we saw this was in 2007, and obviously after 2007, the recession happened and stocks dropped 50% across the board. So maybe the world's not going to be in this risk-free rate at 5% mode that much longer if that were to happen. But if it does stay long for an extended period of time, some of these stocks have to get revalued. That's what we're seeing in the market today. It's just a question of how much lower will they go. And to me, I think somewhere in that $39 to $45 range is probably a fair point to start buying a lot of KO stock. Disclosure, I do own like a tiny bit of KO stock. I have a portfolio that basically tracks all 56 or 55 dividend aristocrats. So there are some of those in there. As always, disclosure and disclaimer, this video is for informational purposes only. It is not investment advice. Do your own due diligence. Talk to an investment advisor before making any investment decision. Make sure to read this before using the spreadsheet that I will include. There could be some errors in the spreadsheet as well. I'm always changing it. I will not update it specifically in the description down below, but you can use it, hit the file button, make a copy, and play around with it if you'd like. For me, if Coca-Cola were to drop down into that $39 to $44 range, I don't remember when I bought it. I bought the stock ages ago within that portfolio. I haven't bought any in a long, long time, but I do own some, like $500 worth. So it's not anything. It's like 10 shares. So keep that in mind. If it were to drop into that range, I'd probably buy a bit more. I do like this company in general. I think, if they can work through the kinks with Body Armor, if they can expand Costa Coffee. They haven't really done much with Costa Coffee. It is a UK-based coffee chain. They maybe have a couple locations in Atlanta, but they haven't really put a lot of investment dollars into that. I think that some of the stuff they're doing on the alcohol side is interesting. That could be a big boost for them. Remember, they own a piece of Monster Energy as well. I think they own close to 20%, and that's a $50 billion business on its own. I'm pretty sure they still own that. So interesting stock. The valuation's certainly getting a bit more interesting, but it's still far from a spot where I feel like, oh, I got to buy Coca-Cola, right? Because there's just other alternatives there. I'm perfectly happy keeping money in cash, earning 5% until stuff becomes really, really attractive. And there's certain stocks that are getting there, but Coca-Cola just isn't there quite yet because it's a slow grower. It's going to keep your money in an okay spot. It's probably going to get you that, 5 to 7% post-dividend return at today's price point. But if you're happy with that, sure. But I would expect you would want more. I certainly want a bit more. But let me know what you think about the video. Let me know what you guys think about Coca-Cola in general, if you agree, disagree, or otherwise. And if you want me to review any specific stocks, let me know down below. So thank you for watching, guys. Hope you enjoyed the video. Have a good rest of your day, and bye.